Just to review for you, we want to scalp off the reaction levels. So assuming a price swing and we have a rally here, we have a level of resistance which becomes support. Price typically will react off this level, and as price moves up, look for the market to bounce off resistance, and then as it pulls back, have your Fibonacci levels established so you can watch where the price may bounce on the Fibonacci levels. On this leg up, there will also be micro ranges that you need to keep an eye on, where the market will likely test and bounce off and consolidate above or below. As price continues to move through, we're looking for support and resistance levels where price may bounce as it swings. Look for price to bounce at pivot levels, fib levels, average true range, fib extension levels. Look for the market to max out on its daily average range. And just these bounces alone can offer 10 or more pips for scalping. You can trade a large number of times in any given day, but the more times that you trade, there's a high probability that you will be trading low probability trades. And so I caution you that you simply take a manageable number of trades if you want to scalp. Maybe 3 or 4 or 5 or 6 trades in a day that may offer a good 10 or 20 pip bounces. The more trades you take, the lower the likelihood that they all will pay well, and the higher the likelihood that you could lose. So make sure that your scalping is manageable. Just a bit of a trade preparation and scalping checklist for you. The tools that you're using are support, resistance, fib levels, pivots, trend lines, etc. Establish your near-term key reaction levels on a 15, 30-minute and or 60-minute chart. Watch your 5-minute chart closely when you start nearing those levels. And of course, when the market starts to trend or move into a larger range, look at your higher time frames. So mark the notable key reaction levels on the higher time frames in the event it is a strong trending or large ranging day. Stock the levels and anticipate a trade and prepare your trade. Pull up your trade ticket window and prepare the trade. You can also use limit buy and limit sell orders. When you're trading, be mindful of any economic reports that are due in the session ahead, whether it's in the session, whether it's in the London session or the New York session, which may come later on if you start trading in the London session. Be mindful of the time of day and the volatility, whether it is New York or the London session, which are typically more volatile than the Asian session. Always enter your trade using the #1 rule. Trade into a bold-faced candle that is moving in the direction opposite to the direction of the intended position, and trade at a key reaction level. Place a reasonably tight stop, and then once the market starts to move in your favor, then you can move it closer to the entry. Take at least 60% of your position out of the market when 10 pips in profit, and move your stop accordingly. So you may want to start moving your stop closer to your entry or to your entry if prices move 10 pips or more above your entry level. Scalping is considered a high-risk trading activity, so certainly exercise caution and be careful out there.